Hello and welcome to this webinar on the Retirement Outcomes Review. My name's Lisa Webster and I'm Senior Technical Consultant here at AJ Bell. I've spent the last few weeks going out and about around the country with our road shows, giving this presentation, and it's all about what the Retirement Outcomes Review means for advisors and for advised clients. As I'm sure a lot of you will be aware, the main focus of the Retirement Outcomes Review was for non-advised clients, but as we will see, there's definitely an impact for advisors and your clients as well. Now, the Retirement Outcomes Review really started, it's from the FCA looking at what's gone on with pension freedoms. We heard a few weeks ago from Charles Randall, the chair of the FCA, talking about pension freedoms, and he was quite scathing really about how they were brought in. He felt that they were rushed through and the government didn't consult properly on it. So I think, certainly how we felt the industry, and I'm sure for advisors as well as providers, it was big changes in a short space of time. And I think the view from the FCA is that had they been consulted beforehand, they would have put, maybe done things a little bit differently, and maybe put some of these measures in place earlier. So now this is almost like a catch-up exercise, really, from the FCA's point of view. So let's have a look at what's actually happened then. So pension freedoms obviously came in back in 2015. Retirement Outcome Review was launched. We knew about it. We had the terms of reference in July 2016. We had an interim report consultation come out, 17-18, which, maybe as advisors you might not see too much of that, but certainly as a provider who has non-advised clients, we had lots and lots of data requests, information requests from the FCA, where they were gathering information to see what's actually been happening under pension freedoms, what clients have actually been doing. And as I say, the main focus of this was for non-advised clients. We had the final report just over a year ago, June 18, and at this point in time we saw the first consultation paper. So this was the first idea we had of what changes the FCA were wanting to make, and these revolved around wake-up packs, annuity information and illustration changes, and these came into force. The policy statement came out earlier this year, January 19, which gave us the final details of the changes that were going to be made. And these changes are very imminent. We have changes to the wake-up packs and annuity information coming in from the 1st of November this year, so very, very soon. And then further changes to illustrations coming in from April next year. So let's look at those changes in a little bit more detail, what came out in this policy statement back in January. I'll just touch on annuity information first of all, because I'm not going to go into too much detail about that because it's not our specialist area. But just so you're aware, from November, whenever you have a request for a quote, an annuity quote, the annuity provider will have to ask health questions to determine whether the client would qualify for an enhanced annuity. And based on that information that they get back, they will have to provide a market leading quote and provide that to the client alongside their own quote. So, if there's a better deal out there, they will be required to tell them. But we're going to look at a little bit more detail on wake-up packs and illustration changes. So wake-up packs then. Changes to wake-up packs are coming out because the FCA found that people were getting information too late and maybe not in a format that was the easiest for people to understand. One of the big findings they had was that people had already made a decision to take out their tax-free cash way before they got the wake-up pack, and so they made their mind up. They wanted to access their pension, whether it was just the tax-free cash, could have been all the pension, and then the wake-up pack would kind of come later, and they'd already made their decisions, so they didn't really bother reading it. So one of the proposals, one of the changes that is coming in, say imminently, is that there's going to be earlier wake-up packs, and we're going to have wake-up packs more frequently. This is the same for all clients, whether they are advised or not. So you will notice that your clients are going to be receiving a lot more wake-up packs. First of all, they're going to get one within 2 months of them turning 50. They will then get one shortly before they turn age 55. And then 5-year intervals until they're fully crystallised. So there's no upper age limit on that as well. So, you know, if you've got somebody who's partially crystallised who's 80, you could potentially, clients could still be getting wake-up packs. Obviously, the idea of the 50 pack is that everybody will get a pack before they can actually access their pension, before they can make that decision. They get another one before they are entitled to access their pension, and then it's sort of on a reminder basis so people don't just forget about it. There's also going to be specific trigger points. First one is going to be shortly before their intended retirement date, which is as it is now. If you haven't put an intended retirement date on the scheme, it'll normally be state pension age. It'll also be whenever an illustration is requested, if somebody's going to buy an annuity from a drawdown pot, and whenever there's a request to access pension for the first time. What it means by this is whenever there's a benefit crystallisation event. So if somebody's partially crystallised, when they go and make a further crystallisation, they're accessing that bit of their pension for the first time. There is a carve out whatever in the rulings that if a wake-up pack has been issued in the last 12 months, the provider doesn't have to issue another one. So, you know, they won't be getting bargained with them every few months or anything, but it could be annually, depending on what the trigger points are, and it will be at least 5 yearly. So I say there'll be a lot more wake-up packs going out. So just be prepared for that, because obviously your clients, when they get these packs, may well be picking up the phone to you and asking what it's all about. But what are they going to get? What's going to be in these wake-up packs then? Another thing that the FCA found is that the information that people were receiving wasn't necessarily in a format that was easy to read and easy to understand. So I could be cynical and say that there was too much information and now they're going to get even more information. But the FCA are sort of really fans, as you will see, of this idea of a single page summary. So it is in addition to the information that they already get, but the idea being that you have a simple one-pager of the basic information, which even if the clients don't read anything else that goes on in these packs, that, you know, they will have a basic understanding of the key points just from reading the single page summary. So that's going to have information on there. Obviously have the client's name, their intended retirement date, the name of the provider, information on contributions. If they have regular contributions going in, that will be on there. Employer contributions, obviously the fund value, details of any guarantees, exit fees, special features, anything like that. There's also a requirement on there for all wake-up packs up to the intended retirement date, shortly before the intended retirement date, where the provider will have to put a statement on there, the questions they're asking, are they saving enough? Are you saving enough money into your pension? And now providers are required to put that in no matter what the circumstances, as I say, up to just before the retirement date. So even if your client has got a £3 million pension fund and enhanced protection, and the provider is fully aware of that, there's still a requirement for us to put that question in there, even though it's clearly not going to be in the best interest to put any more money in. So just want to be aware of if you get asked about that. Pension-wise, they are strengthening the requirements for signposting to pension-wise. So we will have to have a clear and prominent recommendation to use pension-wise, telling clients how to access that service. And again, we as a provider, we are required to put that on there, even if we know it's an advised client. So again, just to be aware of that. In addition to this single page summary and the wake-up patch, you're also going to have another single page. This time it's going to be of risk warnings. Now, the FCA have said that providers can tailor the risk warnings based on the information the provider holds on the client. However, providers, as a provider, we don't know anything like as much about the client as you do as an advisor. You know, we don't know what the client's attitude to risk is. We don't know what else they have in their portfolio, what other investments they have elsewhere, their health, their family situation. We don't have all that information, generally speaking. So you're going to find these risk warnings are pretty generic. The only sort of tailoring you're probably likely to see is you might have something regarding the client's age. It might be tailored slightly to that. So the risk warnings will have obviously things like that their income isn't guaranteed, things about the taxation of flexible pension payments, triggering the NPA, warnings about scams, effects on means tested benefits, etc., etc. So there'll be a number of risk warnings in there. There's also a requirement on certain wake-up packs to put in a statement or a risk warning, a prominent risk warning, stating that accessing your pension at this time might not be in your best interest. So we don't have to put that on the age 50 packs because they don't have the option of accessing the pension at that time, but anything between 55 and up to 7 months before the intended retirement date, so in that period in between, then we have to put that warning on there saying it might not be in their best interest, and that will apply even when the wake-up pack has been triggered by you as the advisor, requesting that the pension member takes their benefits, and you've given a personal recommendation precisely that it is in their best interest to access their benefits. Even if we know that's the case, we still have to put that statement on there because it is a requirement under the COBS rules. So again, just something to be aware of, if your clients get this, why they've had it, it's a regulatory requirement, and we can't change it as a provider. So yeah, just want to be conscious of. So those are the changes coming in 1st of November. We then have changes to illustrations coming in from April next year, April 2020. By now, it's probably going to be no surprise to you that there's going to be another one-page summary, and again, in addition to the usual illustrations that they receive. All illustrations will have to be provided in real terms. So at the moment, there is an exemption if you have fully drawdown. You can just have nominal illustrations. That will no longer be the case from April. For all situations, you will have to provide an illustration in real terms. It may still be possible to get illustrations in nominal terms, but you would have to, if you're providing that to your client, you would have to give it to them alongside an illustration in real terms, not instead of it. We see on the screen there, we've got an example of what information would be in this one-page summary. So we've got things like the term length, amount of tax-free cash, the amount going into drawdown, details of any regular withdrawals or one-off payments. We then have this section on what your fund value might be worth. It's got the assumptions stated in there about growth at 2.5% above inflation. And it says in 5 years and 10 years time what the pension fund might be worth, and then it gives an indication of the age when the pension fund would run out. The idea being that's a bit easier for people to understand. We still have a reduction in yield figure on there, percentage on there, so if you are going to get questions from your clients, it's probably going to be on that one. And then at the bottom we have comparison information. So here we have a pounds and pence figure of all the charges associated with the product of having that drawdown for the first year. So that will include advisor charges and all the plan charges, everything associated with that. That will be on there, and that's been done by the FCA to make it easier for people to make comparisons between drawdown providers. When do you have to provide these new illustrations? Well, we can see we've got the list there. So it's when somebody first designates funds to draw down. So if they're just taking PCLS, not taking any income, you'd have to do it at that point. You then, if they then at a later date start taking income, they turn it on, so they may already be crystallized, but then they just switch on the income, you'd have to do it at that point. And then when you've got UFPLS payments, whether it's a one-off UFPLS payment or the first of a regular UFPLS payment. The only exemption really regarding the UFPLS is obviously if you are taking full UFPLS and you are emptying the fund in one go. Clearly there's nothing left, there's nothing to illustrate, so you don't have to do it in those circumstances. So that was round one of the retirement outcome review. Those are the changes to say that are coming in imminently. But when we had the policy statement back in January, as I'm sure you're all aware, that wasn't the end of it. We had a second consultation paper, CP 19.5 was launched, and this introduced the concept of investment pathways, cash decision and charges information. The policy statement on this one came out on the 30th of July, so just a couple of months ago. And these changes are all going to be coming into play from 1st of August next year. So let's have a little look at those. Now, these changes have all come about because the FCA have been concerned about drawdown customers defaulting into cash. That's the big issue that they have. Now, clearly when they've been looking at it and reached this conclusion, they've not been looking at advised clients, because I think we all know that, if there's an advisor in place and doing their job, then people aren't going to be defaulting into cash. If they may have some cash holdings to provide income for the first year or two, but they're not leaving the whole fund in cash and doing nothing else with it if they're going to be in drawdown for years and years to come. And I don't think there's really any suggestion from the FCA that it is advised clients that are the issue. However, these changes they're making are going to impact everybody. So they've introduced these investment pathways, which I'll talk a little bit more about in a minute, as sort of default options so people don't default into cash. They've introduced rules whereby if you are going to be holding a lot of cash in the funds, that it has to be an active decision. And then they've introduced some changes about how charges information is given to customers to make it easier for comparisons. So looking at the investment pathways then. Investment pathways, you would like to think as the issue is around non-advised clients defaulting into cash, that it would just be for non-advised clients. However, that is not the case. The FCA have stated in the rules that advisors will also have to consider pathway investments, and that is whenever clients are entering drawdown and whenever there's any personal recommendation given regarding existing drawdown funds, and even if your provider that you're with isn't going to offer the pathways. So this means that when you are advising a client to say to go into drawdown for the first time, and you look at their investments, you will have to consider the investment pathways. And if you are recommending that that client makes any investments other than the pathways, you have to first rule out the pathways. So it's a bit like the RU64 rule, where if you want to make a recommendation for a personal pension, you have to rule out a stakeholder pension. Here you're going to have to rule out the pathways before you can recommend that your client does anything else. But it's not just going to be for new clients going into drawdown for the first time. You will have, I'm sure most of you will have many existing clients that are already in drawdown, and some of them will have been in drawdown for many years. When you sort of have your review with your clients and you're looking at their funds, if you decide it's appropriate to make a fund switch for them for whatever reason, you're changing their investments, at that point in time, you will have to consider the pathways. And again, if you want to move them to anything other than a pathway, you will first have to rule out the pathways that are available. I have mentioned on here, say certain providers won't have to offer pathway investments. This is because the FCA have put an easement in place. So if a drawdown provider has 500 or less non-advised drawdown clients a year, so people that don't have an advisor going into drawdown for the first time or making drawdown decisions, changing their funds, less than 500 a year, then they don't have to offer the pathways. If you may well use the platforms that that are just for advised clients. They don't have any direct to consumer offerings that might meet these exemptions. Even if your client's with them, you will have to look at other pathways available in the market before you can decide to make other investments with that provider. Also, what the FCA have done is they have said if it's unclear to a provider whether a personal recommendation has been made, then the provider will have to offer the pathway investments directly to the client. Now, this is a bit of an interesting one in terms of how the FCA allow us to define advised and non-advised clients, because they have stated that we're not, as a provider, we're not allowed to base our assessment on any information that is more than 12 months old. And we are not allowed to just rely on the fact that advisor charges are being taken from the product. So if you make your recommendation to a client to go into drawdown the first time, you send that request through to us as the provider. Obviously, we can see at that point in time, you'll have said, you know, when you've done the drawdown form, that you've made a personal recommendation, so that's fine. We know it's an advised client. 12 months later, you have your review with your client and nothing changes. You know, everything's ticking along nicely. They're taking their income, the funds, everything looks all right. You know, you wouldn't normally come and tell us that, you know, you've had that review. You know, you've still got your ongoing charges going out. It's fine. But once we've gone past that year, we would no longer be able to use that information, and it's more than 12 months old, to confirm, for the purposes of these rules, that that client is still advised. So let's give it an example of where this might cause issues, you know, potentially in the future. I've got a case study here for Peter. So Peter's 65, he's got £800,000 in a SIPP. He's decided he's retiring, he's decided to stop work, and he wants to access his pension. He goes and sees his advisor, and the advisor recommends he does partial drawdown. Obviously, as part of that advice process, you're making the decision about his investments, you will have had to have considered the pathways. But because you're doing that, we as a provider, we don't have to do anything in relation to that. That would be your responsibility at that point in time. So made a recommendation, he takes £100,000 PCLS, 300,000 goes into his drawdown pot. He's taking an income there of £20,000 a year. So the other £400,000 in there is uncrystallised funds. That's fine. But what happens 18 months later, Peter decides he wants to take some extra PCLS. He's not taking any income, he's just accessing a bit more cash. But for whatever reason, he has decided he doesn't want to go through the advice process. He just wants to get his money, doesn't want to pay for the price on it for that specific transaction. But there may still be an advisor in the background who's managing the underlying investments within the SIPP. But when he makes that request directly to the provider to take his tax-free cash, his extra tax-free cash, obviously the advisor can't state they've given a personal recommendation in relation to that because they've not been involved, that the provider would then have to take Peter through the investment pathway process, even though there is an advisor still looking after the underlying investments. This is what the rules state, this is what would have to happen. So what do the investment pathways look like? I suppose is the next question. So obviously this is what a non-advised client, or Peter in his scenario, this is what he would face. But obviously for you as an advisor, because you have to consider the pathways as part of your processes, it'll be important that you have an understanding of how this process works as well. So first of all, as a provider, we will have to ask clients, do they want to use the investment pathways? Do they want to select investments without using the investment pathways, or do they want to remain invested in their current investments? Now that wording will be the same that you will see from every provider because that's set out in the COBS rules. We're not allowed to put option 4 on there, which is go and speak to your financial advisor, which might seem like the sensible thing to do. There are other points in the process we can recommend that to clients if we know that there's an advisor in the background that we might suggest it, but in terms of when we put this question in front of them as part of this process, we're not allowed to add or change this wording. If somebody goes for option 1 and say they want to use the investment pathway options, these are the 4 options. And again, the wording of these options is in the COBS rules, so will be the same for whichever provider. This has been set out by the FCA. So we have option 1, I have no plans to touch my money in the next 5 years. Option 2, I plan to use my money to set up a guaranteed income annuity within the next 5 years. Option 3, I plan to start taking my money as a long-term income within the next 5 years. And option 4, I plan to take out all my money within the next 5 years. So clients, direct clients will have to choose whichever one of those they think is most appropriate. And obviously when you're, as part of your advice process, you're looking at the options for your clients, considering the pathways, you'll have to think which best fits for them. I think we'd probably all agree that that's not going to cover every single scenario that you have. It's not going to be a nice fit for everybody. I guess you might get a few in option one, people who just want to take the cash and probably not taking an income for a few years. But in terms of an investment strategy, option 2 and option 4 I think are pretty much the same, because both of them involve taking all your money out within the next 5 years. So it's not really a long-term investment plan. But those are the options. Once the client has selected one of those options, the provider will then have to put an investment pathway in front of them. So let's imagine that, for example, Peter or the direct client has chosen option 1. So they have no plans to touch my money in the next 5 years. They're just asking tax-free cash in this scenario. So if they are with a firm that offers their own investment pathways, once they've ticked that option 1 box, that provider will have to put a pathway option in front of them. Now that pathway option, it could be a fund, it could be a managed portfolio service, particular investment. We'll have to wait and see as providers develop them, what these are all going to look like. Obviously, these rules only just came out at the end of July, so it's very much in the planning stage at the moment, and nothing's decided yet. But a key point here is that although for any one customer, they can only have one pathway put in front of them, doesn't have to be the same pathway for every customer. Now, I think realistically, it's only going to be age as the deciding factor. So, for example, somebody who's picked option 1, not going to touch their money for the next 5 years. Somebody in the age 55 to 60 age bracket, for example, might have pathway 1A put in front of them. Somebody who's aged 60 to 65 might get pathway 1B, 65 to 70 might get pathway 1C, whatever it is. I mean, and it'll be different with different providers. So key point is that one customer will only ever see one pathway, but it won't always look the same for all customers who've selected that same option. It might do, some firms might just have one option for all, one pathway for option 1. I say it will be different. Now, there has been concerns, particularly providers have voiced their concerns, and I think across the industry, that providers aren't seen to be given advice. So obviously there's a fine line that we really don't want to be crossing. So I think it will only be age that providers can sort of choose the pathways by, because if they start asking too many questions, about risk profiles, health, life expectancy, etc., then they're getting too dangerously close to advice. There has been some guidance issued in the peer guidance on this, which does state basically if you just use age, then we should be okay to do this without it being deemed advice by the FCA. So yeah, so we do have to be careful with it though. Okay, so once pathway's been put in front of a client, the firm will then have to describe the risk level of that pathway investment to the client. We then also will have to state that other firms offer pathways and that the client may benefit from shopping around. And we also have to refer to the MAPS service, telling people how they can access this. So the MAPS service, that's the Money and Advice Pension Service. The new sort of amalgamated financial guidance service. I'll talk a little bit more about that in just a moment. So that's what it looks like if the firm has their own pathways. For a firm that doesn't have its own pathways, but it's not exempt, so it's not a small firm with less than 500 non-advised clients, they still have to offer the pathways, but not all firms will maybe want to offer them or may not have the capabilities of offering their own pathways in-house. They will then have to refer to an alternative firm that offers the pathway. The original firm will still have to describe the risk level pathway investments and state about shopping around in the MAP service. So that responsibility lies with the original provider, even if they are referring elsewhere for their pathways. Of course, if the customer chooses that pathway, effectively that's going to be a transfer out to the firm that actually provides it, quite possibly in a lot of circumstances anyway. Finally, we've got these exempt firms, as I've touched on, the firms that don't have as many non-advised clients, therefore don't have to offer the pathways. So these firms will have the choice of referring to an alternative firm, or they can just refer directly to the MAP service. Now, given the choice that you don't have to refer to a competitor or not, I think most of these firms will be choosing the MAPS option. There'll still be requirements about describing risk levels of the pathway investments and the shopping around part of it. So the MAPS service then, what they will have is they will have a drawdown comparator. So some of you, I'm sure, will be aware of the money advice service. For quite some time have had an annuity comparator service, annuity comparator tables, which they say have been quite easy to do because there's only been six annuity providers at the moment. They want to do something similar for the investment pathways. So they will have a table of providers of the investment pathway. So if you've chosen option one, okay, these are the firms that have option one pathways available. This is the risk level of those pathways, and these are the charges for the first year. Money advice service obviously is now part of MAPS. Apparently they've wanted to have drawdown tables for a very long time, but it's not been possible just because the way the charges work, and and charges are normally dependent on the underlying investments, etc. So it's not something that they've been able to do in the past. But with pathways, because you'll know what the underlying investment is, they think they should be able to do this. So it'll be a first year charges figure for each of the pathways available. And so you'll be able to make comparisons. So look at what the pathway is, look at the risk of it, look at the charges of it. Now, going back to the point that you as advisors will have to rule out the pathways effectively before you can make a recommendation for your client to do anything else. So I think that's going to be a very useful bit of information for you. I think the fact that there's only 4 pathways available in terms of the options that your clients choose, the fact that not all your clients are going to fit nicely into one of those options should make it relatively simple in most cases for you to say, actually, well, because my client's not doing exactly one of these things, they're doing something a bit different, therefore these investments are going to be more suitable than the pathways. You may also look at the pathway, even if they're not touching the money for 5 years, maybe they are just taking their tax-free cash. You may look at the pathway options available, look at the risk profiles, the risk levels of those pathway investments, and go, well, actually they don't match my client's attitude to risk, therefore this is more suitable for them. So I think that will be a useful tool for you in your advice process. So going back a step then on the investment pathways. So if you had Peter, our example earlier, these were the questions that were asked to him. Does he want to use the investment pathways? That's what we've just looked at in the last few slides. The next option for him would be, does he want to select the investments without using the investment pathways, select his own investments? So clients will be able to do that, obviously, but the key point here is they will have to tell the provider what those investments are before they're able to access the tax-free cash or their drawdown, the bit of drawdown that they want to take, whatever it is. They can't do it afterwards. They will have to do it first. Or the third option, which in our example of Peter, is what you would hope your client would do if he's just taking his tax-free cash. You're looking after the underlying investments, the remaining investments. You'd hope he would stay in those that you're looking after. But even if he chooses option 3, it's not just, okay, there you go, here's your tax-free cash, we pay it out. There's another step that the provider will have to go through first. So we would have to remind the client of their current investment strategy. I find the use of the word strategy in there quite interesting because, as a provider, we can tell the client what their investments are in terms of what their strategy is around that. I'm not quite sure how we're meant to do that. We can also obviously ask the question, say, this is your investments, please check it meets your objectives. We then, there's certain requirements around cash, make sure it's a cash decision. I'll talk a little bit more about that in a moment. Again, we will have to remind clients to shop around, how to do it, talk about the MAPS option, and refer them to advice, and again, back to the pension guidance service. All of this means that after August next year, I think however somebody wants to access their pension benefits, it's going to take longer. For advised clients, when you're going through your advice process, is going to take longer because there's going to be an extra step in the process where you consider the pathways before you can make any other recommendations. Obviously, clients go directly, they'll have to go through the pathway process, or they'll have to select their own investments, or even if they're staying in the same investments, this is extra checking step that's in place. So whichever way you look at it, it's going to take longer for people to be able to access their pension. In our response to the FCA on this paper, I'd like to be clear, we weren't in favour of the investment pathways, and certainly not for advised clients, and even really for SIP clients, because even our direct clients have actively made a decision to they've sought us out to take a SIP out with us. No one's made them do it. It's not been provided by the employer or anything like that. They've done it themselves. They're used to making their own investments. We don't think it's necessary for SIPs, and we certainly don't think it's necessary for advised clients. We also, when we were talking to the FCA, we expressed our concerns about the delays, because we think it will lead to an increase in complaints. We think there will be customers who think that it is just providers putting roadblocks in the way and stopping people, putting barriers to people accessing their own money, and that people aren't going to be very happy about that. And the FCA sort of acknowledge that, but they are very clear that they want people to stop and think before they access their pension. They want to put the brakes on things. They don't want to make it really easy for people to get their hands on the pension money. So that's their thinking. So that's where we are on this. So moving on from pathways for a moment. Also coming in from August next year, we have changes regarding cash warnings. So this is where there is 50% or more of the drawdown fund held in cash or cash-like assets. In those circumstances, the provider will have to issue a warning to the client. Now, these only have to be issued to non-advised clients, so it shouldn't come near you as advisors. However, as I mentioned sort of at the start, when we started talking about pathways, as a provider, we can't rely on information that's more than 12 months old, or just the fact that you're taking advisor fees. We can't rely on that to assess whether the client is advised or not. So if we haven't heard from you, you haven't told us that you are providing ongoing advice to your client, if you've not done that for more than 12 months, even if you're still taking your fees, we can't use that information. So we would have to put your client in the non-advised client when we're doing the assessment of whether they've got more than 50% of their fund in cash. And it says obviously providers, we're not obliged to reassess whether you've given a personal recommendation to your client. It doesn't mean to say that we can't ask the question. Some providers might, some providers might not. What it might be worth you doing is when you have your annual review with your client, even if nothing changes, is just dropping your provider a line just to confirm, drop them an email just confirming the fact that you have had that meeting, you are providing ongoing advice, you've made a personal recommendation that they remain invested as they are, in which case if a provider has that on their record, at least every 12 months, then you shouldn't have to worry about these rules because it shouldn't be affecting your clients. But if it does impact the clients, what it is if, say, there's more than 50% of cash or cash-like funds of the drawdown pot, but a lot of providers don't separate the drawdown and non-drawdown fund. If someone's partially crystallised, they don't sort of ring fence them. We don't do that. So in which case they could look at the whole fund. Any funds that are held with a DFM account, an underlying DFM account, the amount of that DFM account will count towards the assessment of the 50%, but any cash in there won't count towards the cash total. But where there's more than 50% in cash or cash-like funds, then the provider will have to issue a warning, including an illustration of inflation erosion. We will have to remind clients of the investment options available, so the pathways, or if they want to select their own investments. We can also point them back to their advisor. We could say, recommend you take financial advice, and again, tell them about accessing the MAPS drawdown comparator service. Final change that we have coming in from August next year is regarding to charges information and how clients get charges information. And now this is going to impact all what the FCA are calling accumulation consumers. So that is anybody that's in drawdown, partially or fully drawdown, but also anybody that's ever taken a UFPLS payment. So it could be for include customers, clients that they are fully uncrystallised funds, but because they've had a UFPLS in the past, they will be included in this. So this is going to include aggregated charges, so all charges associated with that drawdown pot for a year, including any underlying transaction charges, all your underlying investments and advisor charges. So in terms of the underlying investments, we know from the MiFID II requirements how difficult that can be to get those charges in all circumstances, but we will have to make reasonable efforts to get that, and if we haven't got it all, we will have to state that. The advisor charges that are included will be any advisor charges that have been taken from the SIP wrapper itself, and also from any underlying investments. They will be in there. So there'll be a written statement telling them, what the advisor charges on there. These rule changes come in from 1st of August next year, but it's for charges incurred from that date, and they have to be provided at least annually. So in theory, it could be 31st of July 2021 before some people get them. They're likely to be, maybe a part year and then in line with the tax year, or potentially, with your annual statements, if that's different on that basis. So that was the part 2 of the retirement outcomes review. We do know that the FCA have already got planned in a post-implementation review for a year after the pathways come in, so going to be August 2021. So they will have a look back then. I'm sure they'll gather more information, have a look at the analysis and look at how things have actually been working. And who knows, we might have further consultations and changes to come following that. Just one final point to cover, not technically part of the retirement outcomes review itself, but certainly connected. Earlier in the year, the FCA issued this paper, consultation paper 1915, on IGCs, independent governance committees. Some of you will be aware of these already. They're already in place for workplace pensions, and they oversee the main job they do is overseeing value for money of workplace pensions. The proposal from the FCA is to extend the remit of IGCs. There's a bit in this paper about ESG concerns, but the relevant bit for the retirement outcomes review is that they will have oversight of the pathways. There's no plans in place at the moment for a charge cap on the pathways. FCA is something they haven't ruled out, but it's not something they're looking to do from outset. But this is the method that they want to ensure value for money, is to have IGCs in place. In sort of the feedback statement and the preliminary documents with the consultations that they've had on this, they asked providers for their views of whether it was appropriate for IGCs to provide oversight of the pathways, and I think from reading this and certainly our response was overwhelmingly a no, that we thought it was disproportionate because of the cost of the IGC relative to the benefit. And to give you an idea of those costs, in this paper, the FCA's own estimate of the cost of running an IGC per firm was between £350,000 and £500,000 a year. So substantial costs of running an IGC, and they say that's a per firm cost, when you might have relatively small number of people in pathways. So we will be providing our own pathways. We're not exempt. We do have non-advised clients. However, because our non-advised clients are relatively engaged and used to making their own investment decisions, we are not expecting a high proportion of them to go into the pathways. So we could end up with a very small number of people in pathways, and according to the IGC's, to the FCA's figures, you could end up with £500 million bill, which doesn't really stack up. We've certainly put in a very robust response to this, that we feel it's disproportionate. We have a lot of other governance in other areas. We're PLC, we have non-exec directs, we have investment committees, we have non-execs on that. The other requirements that we have, we just think this is disproportionate. But we will wait and see the outcome. The policy statement on this is the FCA have said is due out Q4 2019. So it is due out any time. Obviously, it could be late December before we see it. We'll have to wait and see. But the FCA have said that they would like the IGCs to be in place and sort of to be involved in the building of the pathways, not just sort of to rubber stamp them before 1st of August. To be involved in sort of providers putting them together to make sure they do provide value for money. Doesn't give an awful lot of time to gather the expertise and put together an IGC, get everything in place. They get to know the company and get to know how things work, build the pathways and have everything ready for the 1st of August. So we'll wait and see. We hope that we might be listened to on this response. I think certainly across the industry there's been similar responses. So we will wait and see, because potentially, the cost of an IGC can have a big impact on the pathways, certainly for, smaller firms offering it, or there's less take-up of the pathways. So we shall wait and see. So on that note, I shall bring the webinar to a conclusion. Thank you very much for listening. Goodbye.